there's more to come. It's not as though we're at full penetration of folks that should be investing within these demos. And I think we'll start to see greater and greater percentages investing in the markets and playing catch up against previous generations' investing behaviors.
The Phil Bach Podcast. Investing, economics, entrepreneurship.
Welcome back to the Phil Bach Podcast. Thank you for joining the conversation. I hope to make it worth your while, and we have a great guest today. Joining us from New Jersey is Stephen Sikes. Steve is the COO of Public.com, an investing social network on a mission to make investing inclusive, educational, and fun. Prior to joining Public, Stephen led SoFi Invest, and he's also an Army vet. We're going to talk about fintech. We're going to talk about payments for order flow. We're going to talk about the staying power and the massive growth in retail investing that we're seeing now like we've never seen before, and more. Steve, thank you for joining the podcast.
Yeah, of course. It's great to be here.
All right. So I've been playing around on Public, and I can tell you it is a lot of fun, but tell me in your words, tell me what the platform is.
Yeah, so like you said, I think you summarized it really well. So I'm glad you've done your homework, and I'm glad we've gotten you on the platform.
I did pull that from your website, so
that's awesome. You've done your homework, and maybe some of your listeners can follow you there as well, and myself. But generally, Public is an investing social network. So I think the shorthand for people that haven't seen it is to think about a little bit of a classic social media feed integrated with a really investor-friendly, self-directed brokerage experience. And so we see sort of a lot of power in putting those two things under one roof, both from a sort of member and long-term investor perspective and from a business perspective. I think the value in both of those ultimately accretes to our members.
So there's so much here to talk about and dig into the growth of social media and the combination of social media and investing, but we can get into the, nerdy wonky stuff and everyone's talking about what happened with Robinhood and payments for order flows and all these market structure stuff. But first I got to ask, how did you get to 1 million members in just 18 months?
Yeah, so I think it's a great question, and I wish I could take any credit for it. I think I might be able to take a tiny bit lately just by virtue of helping smooth out some of our operations and approval funnels. But in reality, we've got the honest-to-God best in the business product, engineering, marketing, growth, communications team. I can only say that I appropriately appraised the quality of the folks from the outside in as I was sort of thinking about my career maybe last summer and looking at who was doing really awesome stuff and where there was an opportunity. And under the leadership of Life and Yannick, our two co-CEOs, I think we've got the best in class folks in both of those in all of those disciplines. So, generically that's the high level. But if you ask me, hey, as a business operator, what's the secret sauce? And I think it comes back to three things. First and foremost is the incredible community of investors that are built on Public. And what that community serves to do is make it really, really easy for relatively new investors to come to the markets, learn about them in a safe way and in a consumable form factor, and help them really learn and become better investors over time. And that sort of thing spreads, and it spreads via offline communities. It spreads via word of mouth. It spreads via online communities. And we've seen a lot of sort of that referral and organic traffic come by virtue of the community. The second thing I think is we've built a really incredible brand, and that brand stands for something. And I will synthesize here, but what it stands for is really caring, and I'll use some French, giving a shit about the investment returns of our investors, and actually looking and saying, hey, how do the people that invest on Public perform over time? Do we help them build better investing habits? Do we help them, honestly, at the end of the day, have more money than less money by virtue of accessing the market? And I think that sort of ethos at its foundation has really boiled up to a brand definition that's resonated, especially in this day and age, and especially over the last month or two with the population at large. And the third thing is bring all of that to bear in a really incredible user experience. And the smoothness and the funness of investing on Public, I think, is obvious from the first time you use it. And we work really, really hard and pay very close attention to detail to make it just feel awesome and fun to invest, which is what it should. And I think there's been a lot of conversation about the gamification of investing in this space, but I think there's a sharp line between gamification of investing and just making it fun, and those two things can coexist. And I think we think that investing should be fun and interesting, and that will lead people to be better more engaged investors, and that's great. And I think we have to do that in a way that in a form factor that helps people be better long-term responsible investors as well.
Okay, so there's a lot there. There's a lot there to unpack. So, I think when you talk about the app and the trading platform of Public being fun, I can vouch for that. I'm on it. It's a lot of fun. It's a lot of fun to use. But one of the criticisms that comes along with making a fun app that's associated with investing, like you touched upon, is the fact of gamification. And when you bring in gamification, are you incentivizing the wrong thing? Is it any different really than gambling? Is it any different than the tricks that casinos use to try to keep people in and try to keep people playing the slots? And I know you guys have spent a lot of time focusing on education and different things that you can add to the app that you've built in to help people be disciplined and trade the right way. What are some of those?
Yeah, so I think well, let me step back before I get into the specifics of what those are and just address the point, which is just because it's fun to use doesn't necessarily mean it pushes people to trade more, right? And I think that's where we're trying to draw a bright line, is saying, hey, investing should be fun. People should be engaged with their money. They should be engaged with the markets. That doesn't mean that they have to be trading every single day in and out of positions, day trading, taking on leverage, trading options, and really, exercising those gambling behaviors that I think you alluded to earlier, Phil. And I think we're trying very, very, very hard to make investing fun, but in a way that is aligned with sort of the best practices of great long-term investors. So, again, deep understanding of the companies people invest in, striving towards greater diversification over time, continuing to sort of view a cash flow based investing where people are putting in a responsible amount of money over time, and then trying to avoid sort of the negative impulses or the negative emotional impact that the markets can have where people trade too much. And so I think what we've done to take that to a really specific point, which is to get to the original question, Phil, was, I'll point to a few different features, and this isn't all of them. One, we've built a dedicated long-term portfolio within our user experience. And it's relatively simple. What it does is it lets users take some subset of their portfolio, literally drag and drop it into a different part, a different sleeve, if you will, called their long-term portfolio. And we put some UI and a few messages there about what that means to view something as being part of their long-term portfolio. And it sits there in sort of a different section of the app, and it has a little different look and feel. And then if somebody decides to trade something or sell something out of their long-term portfolio, they've got to go through a couple extra steps of friction. So they got to slide a little button and so on. And again, it's just one of the ways that we help people make a commitment to themselves and really specify this is a long-term investment. We help them live up to it. The second is, and this is one that we've gotten a lot of attention for more recently, because it was a useful feature of the last couple of months, but we put proactive warning labels on several different categories of securities. And what those warning labels do is they just provide investors additional context about the specific securities they're investing in. A good example of warning labels, and this is one that I love, are leveraged and inverse ETFs. So I don't have to tell you, Phil, it's an area that you know really, really well. These are products that have a very specific construct and have very specific use cases. Oftentimes, they're not appropriate for, say, buy and hold investing. And on top of that, they come with a lot of, sort of natural volatility, almost as a feature in some of the funds. And it's important that retail investors know what that is and actually consume some education on the way to investing in them. And that's something we've put in place via, again, we call it a warning label as the feature definition, but really what you see is when you want to buy, SSO, for instance, you slide to confirm and you see a little message about what leveraged ETFs are and what the appropriate uses are. And then you can go on your way and buy or sell them. Oh, yeah, I should probably step back quickly and say, I've been saying warning labels for a minute. I think we technically call them safety labels, of course. We definitely want to provide education more so than warnings specifically.
And have you found that makes a difference in investor behavior?
Yeah, I think it does. Interestingly, you asked the question because it's something that we're on the cusp of studying in a more rigorous academic fashion in the not too distant future, which is something we're really excited about proving out. But I think anecdotally, as we talk to our members, it's something that, one, we've identified plenty of opportunity or plenty of situations where we've gotten the feedback that, hey, this provided more information about a given security, particularly when you start looking at the really speculative and low market cap stuff that somebody might have read about somewhere, either on Reddit or on Public, for instance, and they go and do a little bit of research and may not quite have realized fully what the security was and exactly where it sort of fits in the volatility spectrum.
Other things about the platform, you can't go short and you can't trade options. Is that by design? Is that something you're trying to build in now, or is that because you think that those are harmful to investors?
I mean, I think when we look at it, when we look in the mirror and we say, what do we enable people to invest in on the platform? I think the test goes, this is generically speaking, the test goes something like this. Is this security? Is this something that could fit in someone's long-term investing portfolio, right? And when I say someone, I really mean the vast majority of retail investors. And I think what we've found is, the truth is, like 99+% of retail investors really don't have a business going short anything or trading options. I think options, we can dive into some option strategies that may or may not be appropriate, but I think if we took a fair and balanced view of the options investing and options trading landscape, particularly for retail investors these days, I think we'd find that it's not selling covered calls. It's not buying puts as protection on existing positions. I think what we'd find is there's a lot of short dated out of the money option trading going on around earnings and news events. And you said the word earlier, Phil, but that's gambling. Those aren't behaviors that are aligned with, the vast majority of investors' long-term investment behaviors.
Yeah, and I got to say, I feel a little guilty. I'm sitting here and the NASDAQ is sliding, and I'm considering closing my short-term Tesla puts right now as we talk.
Yeah, that's right. And, Phil, you sit at a different level of sophistication in the spectrum. And I think as we talk about options, I think one of the things that, I believe, and speaking for myself more so than public policy, than public's policy, but I think it's okay to let people invest in trade options even. I just think there's got to be a level of suitability verification going into it and make it very clear to draw a bright line for those investors that this thing you're doing is not really long-term investing. This thing you're doing is gambling, and most people don't make money doing this. The corollary I like to draw often when this comes up is the in the UK, the FCA, the Financial Conduct Authority, has a disclosure rule around CFDs, which are contracts for difference, which are effectively binary bets on stocks and securities. And those CFDs look a lot like, again, just stylizing here, but look a lot like short dated out of the money options in the US. And the FCA said, if you're going to sell CFDs to retail investors in the UK, you have to have a disclosure that tells those same retail investors what % of people make or lose money in those securities, right? And I think the numbers are always, if you go look, it's funny, you can look up some of the big brokers that trade CFDs, and if you look at them, they're almost all like 70-80% of people lose money investing or trading CFDs. And I don't think, again, my guess is that our US retail investor options trading experience would be quite similar if you looked at it.
I would guess the same thing. I spent early in my career, I spent 2 years at an FX dealer, and it was the same thing. Everyone came in and they had unlimited leverage to hang themselves with, and they did, and people lost money, and it was really horrifying to be on the on the brokerage side of it and to see that. And you want to help people, but you're also, nobody's looking at, me at the time. I was like an analyst, on the desk, like nobody really cared what I had to say, and they weren't looking for me to, they wanted to do what they wanted to do. But there was an interesting thing that you told me about, which is the life cycle of an investor. And in particular, what I was really interested in when you told me the correlation between time in the market, tenure in the market, and ETF ownership. Tell me about that concept.
Yeah, so I think this goes back, actually a couple of steps in my career, but I think everywhere I've been, I've tried to sort of look at this question of when somebody starts investing, how does their portfolio diversification change over time? And I think a little bit of it started with me trying to get my head around, this idea that relatively new investors tend to start in the markets with what I'll say are suboptimal investing choices. They're often investing in single stocks, often more volatile single stocks. So Tesla is a great example. And they tend to be highly concentrated, almost definitionally, right? And sometimes that comes back to just only having a few dollars or relatively few dollars to put in, and having, only be able to access certain numbers of shares, which has changed with fractional share ownership, but albeit slowly. But a lot of it's just behavioral. People, the first thing that brings somebody to the markets is, hey, I want to bet on Elon Musk, for instance. And that's a common behavior that we've seen in the last several years. And what I've had to get my head around as a professional and as an investor myself is that behavior okay? Should we be doing more to help people start out with a more appropriate investment or a more diversified or closer to optimal investment portfolio? And what I found are two things. One, if you try to push them before they really start into something that's more diversified, you tend to reduce conversion pretty dramatically. People tend to like to buy their Tesla stock, right? They want to, if that's what they want to buy, that's what they're going to buy, and that's okay. And if you try to put barriers in place to getting them started, or if you try to nudge them towards a robo advisor, you're going to make it harder for them to get started in the first place. And I think that's a net negative. And the second thing, which goes to your question, Phil, is if you let them start there in what we would call as professional suboptimal investment portfolios, over time they improve sort of naturally, and it's magical. You see them start from a position that might be a single stock position on day one. By day 7 or 14, they own 3 or 4 different names. By day 90, they've got 6 to 10, and then somewhere in those first 90 days, they've probably bought their first or second ETF on average. And you start to see, hey, their portfolio over time both diversifies naturally and also starts to move into, what I think, you and I are ETF guys, I think at our core. That's at least how we met. And, you start to see them move into better sort of products for long-term investors. And at Public, we're still really at the early stages. Our average tenure of member is still quite young because we're growing so quickly, but we're seeing a lot of those same trends play out. And we're really, really excited about what that means for the model.
Yeah, and what really makes the platform special is the social aspect of it. So when you trade, you automatically post to your feed. Everything is public, of course, like the name, but you can go public.com/Phil Bach. You can see all my funds that I'm in. You can see Steven at public.com/Sikes. And then every time you make a trade, you post. And you can also post different commentary, and people have these discussions. You've got Doug Bonaparte is always in my feed. He's the best. So shout out to Doug. Helping people, giving people advice, showing people what he's buying and selling and owning or not trading, and giving advice to the market. What we saw from Reddit, right? What we saw from Reddit, the buying frenzy in GameStop and AMC, it was hysterical. It's hysterically funny on one hand. It was frightening on another hand. A lot of people lost money, so it wasn't necessarily a great thing. It was certainly unprecedented, but it proved beyond a reasonable doubt that the retail market is here. The retail market needs to be heard. It is massive. So by taking social media now with this retail market and putting it all together, you're really creating the socialization of investing, which is just such a fascinating thing. I mean, I'm on FinTwit all the time on Twitter. FinTwit is what we call financial Twitter, and, discussing investing in stocks and different things. And it's a whole, such a healthy forum for people who are, looking to learn and looking to do things the right way. And to bring that all into one platform is really cool. So tell me about that. Tell me about how social media is a part of all this.
Yeah, I think we're seeing, and this is really beyond the walls of Public, but I think we're seeing with the GameStop saga and so on, we're seeing sort of the retail investor interest in the stock market play out at internet scale and doing it in really hyper focused ways, which is driving some very honestly just some point period full stop unprecedented behavior in certain securities. And it's interesting at a minimum. I don't know if I want to put a normative label on it, but it's a fascinating time to be observing the markets. And I think we're seeing that across all varieties of the brokerage industry. Within Public's four walls, honestly, it's been a muted response. I think we've definitely seen some of these high interest names be among the most traded on our platform, but I don't think we've seen quite the spread that you might have suggested, that you might have assumed. They've definitely driven a lot of retail interest across the market, but I think every day we look at, hey, what's trading here and there, and admittedly, while GameStop and AMC and the like have often been in the top 5, it's not as though they've been sort of leading the pack every single day and by multiples that you might expect based on the media coverage and sort of some of the change in some of the volatility we've seen, including even more recently today, now in early March.
Do you worry that we might be at the end of a cycle with retail, or do you think retail is here to stay?
Oh, no. I mean, I think we've seen a secular change in retail, and I think it's here to stay. The particular segment of the retail market that we play in, so particularly the younger end, call it millennial and Gen Z, and especially in the millennial generation, which now actually has disproportionate dollars relative to Gen Z, I think what we've seen is this generation and my generation started investing relatively late. I think many of us were at formative investor years around the global financial crisis. And I think that plus the dramatic increase in student debt load for our generation have led to us getting into the markets, or my cohort getting into the markets later. And I did some research earlier in my career, back in 2016, 17, 18, and saw that fewer than a third of sort of young, high-income millennials, so segmenting just for millennials that have disposable income, you'd see fewer than a third of them were investing in the markets outside of their 401k. Now, the good news was in that segment, 401k adoption was quite high, which is great, and I think great for their retirement. But I think you and I know that most people need to be doing more than that, especially in the segments we're talking about. And so I think what we've seen over the last literal year is that cohort catching up. And maybe it was at a third, but maybe now it's as much as a half, or 60% of that cohort are now investing sort of outside of their 401k. And if I were to guess, one of the ways that we benchmarked this previously was, sort of looking at millennials versus Gen X and previous generations in terms of average investing behaviors by certain ages. And I would guess that even to this average age for the millennial generation, there's still behind prior cohorts in terms of overall investing behaviors, certainly on a dollar basis, if not on a numbers basis. And I think for that reason, admittedly, my bet, and I think this is a little bit public's bet, like there's more to come. It's not as though we're at full penetration of folks that should be investing within these demos. And I think we'll start to see greater and greater percentages investing in the markets and playing catch up against previous generations' investing behaviors.
All right. Let's do payment for order flow, because this is a real, just a fascinating debate. There's nobody who's on the fence on payment for order flow, right? Depending on who you talk to, it's either driving efficiency and democratizing trading, or it's a way for retail to participate at better efficiencies, or it is a mechanism for Citadel to steal from students and trading hobbyists and, widows and orphans. There's no in between. Everyone seems to be so firmly on one side of the fence or the other. You guys just made a big announcement, which is that Public is no longer accepting payment for order flow at all. So help us understand what payment for order flow is and why that's a differentiator for Public.
Yeah, so we'll start with what payment for order flow is, and then we can maybe go through a little bit of the Public story and why we've made the decisions that we have. So payment for order flow, simplifying a little bit, is when a retail broker accepts Phil's order to buy one share of Tesla, I, the retail broker, have to go and find someone to trade with Phil. And I've got to do that within some regulatory constraints with best execution, which will abide. And I think what the way the market structure has evolved is the retail broker will strike direct deals with market makers, or call them what you will. It's the Citadels and the Virtues of the world, and market makers, liquidity providers, wholesalers, but really trading firms is probably the biggest, most encompassing definition. They'll strike direct deals with those trading firms to fill that one share of Tesla trade that Phil had, and give an execution. And in exchange for, the trading firms want that flow, and we can go into maybe why that's the case, but they want that flow. And so as a result, they're willing to pay Public or the other retail brokers for the privilege of receiving that flow on a sort of directed basis. And that's that payment, that rebate that goes back to Public, is what's called payment for order flow. Now, there's another part of that transaction I think is important and gets talked about a fair amount, which is, as a part of that transaction, many of the trading firms, and on some subset of orders, are able to provide some price improvement to Phil on his order of Tesla. And what that price improvement means is, if the NBBO is, on a given share is $101 on the offer, and Phil wants to buy one share of that stock, they might give that share for $100.99. Just, again, 1 penny inside of the best offer, giving Phil a 1 penny price improvement on that share. And so that price improvement sometimes can come, again, via this wholesale route. So then that's sort of the micro view of the conversation. I think there are a couple things that we stepped back a couple of months ago and started to evaluate this business practice, as many people in our community and in the fintech and investment community started to ask questions, and we saw it as a good time to evaluate the business practice. And when we stepped back, we saw a few big problems with it. And the first and foremost is just that it creates a conflict of interest. Payment for order flow creates an incentive for Public to want to force or push its members to trade more. And going back all the way to the beginning of our conversation 25 minutes ago, Phil, we don't think that's right. We don't want that. And anytime you align a business's incentives with a particular, user action at tech scale and with technology involved, you end up in these sort of feedback loops that drive people, and the technology drives people to take certain actions. I think we've seen that in other problematic cases where if the revenue comes from X, the platform is going to push customers to do X. And I think you could look at, again, the entire sort of tech and internet economy and see that being true in many cases. And we thought that direct link was really problematic for a business like ours that, I'll say again, genuinely gives a shit about our members having better investment outcomes. And stepping back, we felt like we had to get that out of our business model, and we had to find a better way. So that's problem one. Problem two is, I think is the broader market structure around payment for order flow and sort of who the trading firms are. And the short version there is, and there's a lot of detail and probably not right for this forum, but the honest answer is these trading firms are pretty opaque. And while they have a regulatory responsibility, as we do, to give customers the best execution on an individual trade, there's very little constraining their actions outside of the context of an individual trade. And it's not that there's anything wrong with the activities that the trading firms take outside of the context of those trades. It's just that there's few constraints and very little transparency into what those activities are and how they might impact our firm or our investors' interests. And we think there are better models that we want to push towards over time and push the industry towards over time that sort of eliminate some of that opaqueness or some of those potential conflicts of interest there.
You guys are all about transparency, right? So it's all about showing everyone what you own, and, every trade gets posted. So, what better place to lead with transparency on the execution side? And I think that's great, but you replaced it or you added a tip feature, right? Where after you make a trade, you can tip back to public for the trade execution, right? Does anyone actually leave a tip?
Yeah, so it's the descriptions. It's a little bit. The tip itself is not directly tied to the trade, so it doesn't influence execution or anything like that. It's just a purely optional, voluntary, opportunity for our community to support the model. And I think the full loop comes back, Phil, to the idea that really a lot of our decision making around payment for order flow came from our membership and asking us about the model and pushing us to think of a better way. And we saw, hey, in doing this, we have to find a way we're still a business. We have to find a way to run our business. And one of the revenue models that we thought would help compensate for, again, removing the payment for order flow revenue stream and actually absorbing some increased costs of going directly to exchanges for execution was to let the community support it. We thought we were doing something that was really community oriented, again, removing the conflicts of interest on a couple of different levels. And as a result, asking our members to do that. And we think it's really well aligned. And we think our members are given again, fully optional voluntary opportunity to sort of vote with their dollars on how they feel about the model. And it's going okay so far. We're a few weeks in. I would say it's sort of met our expectations.
It's definitely outside the box, and I think it goes along with the kind of fun, light concept of everything you guys are doing. So I hope it does work. I think I'm more inclined to tip, just like in Vegas, right? If I lose money and close out a trade, I'm probably not going to tip. But if I win big, maybe I do. So I think it's cute. I think it's fun.
Yeah, that's cute. That's what we're going for. Phil, cute. That's a good. Honestly, that's a good. You've hit on something I think we should definitely send our analytics team after, our data team after, is look at tipping behaviors on winning trades versus losing trades and see how the selling impacts that. And I think, what I would expect is over time, I think we want this to become more of a community supported model. I think there's truth to the phrase that if you're not paying for something, you're the product, right? And I think giving our members a way to directly support the platform and support our transparency and support our business model is the real long-term solution here, and something you'll see us continue to push on both in tipping and other ways or other potential revenue models where that we're really excited about.
So Steve, you spent the past 8 years working to make markets more accessible, previously leading the SoFi Invest products. What trends in fintech do you see making the biggest impact over the next 5 years?
Oh, that's a good question. Wow, stepping back to big time fintech universe brain stuff. I think that the coolest thing I've seen from a fintech perspective, and I think the trend line has been the improvement of the underlying technology providers. And I don't mean, the publics of the world. I mean, really the base layer technology that helps enable companies like Public and companies like SoFi and companies like Chime, those base level financial services providers that provide that infrastructure to consumer facing fintechs like ours. Those companies are improving at such a pace, and there are so many more of them building that SaaS infrastructure layer for fintech that over the next 5 years, we're going to see it get to a place where launching consumer financial services will be, I don't know if it'll ever be trivial, but it will become much easier. And I think what you see when it becomes much easier to launch new investing businesses, to launch new banking businesses, to launch new card businesses, to launch new lending businesses, what you'll see then is a massive surplus to customers as companies can serve smaller, sharper niches of consumers with better, more tailored financial products. So I think there's going to be this, I don't know if I have a good word for it, but this hyper specialization of consumer financial services companies that's driven by the increasing ease in launching consumer financial service companies. That plus, I think the next leg there will be, we will see a proliferation of companies launching that do more than one financial service from day one. So right now, I think the history of fintech, at least to this stage, has been really single vertical fintechs. Again, Robinhood, Chime, SoFi, et cetera, launching and then expanding their portfolio over time into banking, cards, lending, or investing, depending on where they started, and building out rebundling that full banking portfolio over time. I think what we're going to see over the next 5 years is companies launch with many of those from day one. And I think when you build a business from day one in consideration of having all of those verticals, I think it unlocks a bunch of really cool value propositions that maybe, you and I might struggle to conceive today. But I think as you think about how that might impact very specific niche consumer segments, I think we're going to see some really cool stuff. And I'm excited for what's going to come.
Yeah, I completely agree. It's really exciting when you look at the integrations. I mean, nobody wants 30 different apps to open for every little feature, right? Everyone wants everything all integrated. And I agree with you as well about the accessibility of products. I'm really excited about these NFTs that we're seeing. And I know it's a big joke that, people are selling their tweets and their GIFs and, the whole thing is a big joke, which I think it is. I think it is ridiculous. But as a proof of concept to show that you can now securitize digital assets without any friction at all, immediately get it out into the market and let people trade instantaneously. That is pretty exciting. You start thinking about where else that could be applied to. And I think the upside is pretty significant. So it's an exciting time for fintech.
Yeah, I'm an NBA Top Shot mini whale. I got in a little bit early. I got in like early January as I started to see. I think honestly when NBA Top Shot popped its head up in FinTwit, and I think it must have been like the first week of January was the first time I started to see a little bit of heat coming from crypto Twitter and FinTwit, and I got in a little early and doing okay so far. But I think it's really cool. I think it's cool to see digital collectibles really gaining some steam. Again, I think people will always, like any variety of collectible, there are people that will be skeptical of it. But the truth is collectibles just exist in the eye of the beholder. And that's all it takes for it to be valuable. It's just got to be valuable to someone. And I think we'll see some really, really cool stuff. And I'm excited to see what comes.
Yeah, no, I agree with that. Well, Steve, I like to ask this closing question of all my guests. Tell me an obstacle that you've had either in your personal life or your career that either found a way to work around or just persisted right through.
I've been really fortunate and privileged in my life to have gotten really lucky in a few different places and a few different times. But I did have one point of questionable luck, and in hindsight, it was even more risky than I sort of assumed. But I had started my career in the Army, but then I got out and went to McKinsey, and I made my decision to leave McKinsey after about 4 years there and joined SoFi to help start what is now SoFi Invest. And that was in early 2017. I think anyone that knows the fintech space knows that SoFi underwent a management change sort of in late, fall 2017. And I found myself working on a business unit that didn't exactly have, that may not for a time have had a future, and it wasn't entirely clear. And I think it was one of those situations where I was young and hungry, and we were just driving to try and build this business and get it funded every day, and didn't fully realize the existential risk to the project that we'd been working on. But it was a really tough time for the company, a lot of back and forth. And, we had to drive really hard to keep attention from one management team to an interim management team, ultimately to the new management team, and persevere through a lot of uncertainty in order to build that business and get the funding. And honestly, without both John Gardner, who was my boss at the time, helping keep everything on the rails and continue to advocate for the future of what became SoFi Invest, and then if it weren't for getting such a receptive and innovative management team led by Anthony Noto, who continues to lead SoFi today. If it weren't for those two, it would have been hard to persevere and push through into ultimately what I think became a really great product. And I'm really excited to see where SoFi Invest has continued to grow and will continue to grow as a component of a soon-to-be successful public company. So it was definitely a tough time for all of SoFi. I was really proud of the team and the folks I got to work with in helping push through that tough time and ultimately see the other side of it like we have.
That's awesome. Well, congratulations on your success, and congratulations on Public's success as well. Where can people follow you? Where can people sign up for Public?
Yeah, of course. So I think you said it earlier, but public.com/Sikes, Sikes. You can see my portfolio and sign up for Public there. You can also find me on Twitter at Steven Sikes, STEPHEN, Sikes _. And DMs are open. Happy to chat with anyone about Public or otherwise.
Well, thank you for coming on the podcast. It was great to hear from you. Thank you to our listeners. You are appreciated. We'll be back with a new episode shortly. Make sure you are subscribed so you catch that one too.
Thank you for listening to the Phil Bach Podcast. If you enjoyed the show, please take a moment to drop a review. This show was published for entertainment purposes only and is not investment advice. Please contact a licensed professional before making any investments. Some of the securities discussed on the show may be owned by its participants. Opinions expressed on the show may not reflect those of their employers. Stay hungry and stay foolish.